The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. One of my favorite people to talk to. I have a ton of respect for this gentleman. His name is Grant Williams. He really needs no introduction. Grant, welcome back to the Rebel Capitalist Show.
Hey, George, how are you? It's been a while.
Yeah, it's been a while, but I've been listening to your new Endgame podcast with Bill Fleckenstein, and I've actually used a couple of those podcast episodes for whiteboard videos, specifically.
All right.
With Lacey
Yeah, no, they've
Hunt.
been great conversations.
Yeah, great. That's that's an understatement. I think those are some of the best podcast episodes I've ever listened to, and we'll get into that in a moment. But to start, I want to go back to another podcast that you did with my good friend Eric Townsend on Macro Voices. And you guys both have really done a lot of research on the fourth turning and kind of where we are in that process. And what really stuck out to me as I was reviewing it is that if we are in this fourth turning right now, from a standpoint of social unrest and what we're seeing in the United States and in a lot of the developed countries, this has got another 8 years to go. So for those of the people who maybe aren't familiar with the fourth turning, can you explain that and then go back and revisit your conversation with Eric and kind of unpack that for everybody?
Sure. Yeah. Look, The Fourth Turning is a phenomenal book written by Bill Strauss and my friend Neil Howe. It was written a couple of decades ago, and it's a look at cycles, societal cycles, and what happens, what tends to happen as these things repeat through history. And the fourth turning is characterized by exactly what we're seeing now. Upheaval. It's a change in power between generations. Society tends to break down. We have debt crises. The whole thing. I mean, it's an extraordinary book, and if your viewers haven't read it, if you can find a copy, you may have to order it. It's tough to find, as I found out when I tried to buy a few copies for friends recently. But it just shows you how these cycles repeat through history, and unfortunately, the big common thread in all fourth turnings is conflict, and in many cases that means war between nations, not just civil wars or internal strife, but cross-border wars. And so as we watch what's happened, the fourth turning began around 2008, funnily enough. As we watch what's happened with that, you get to where we are now, and you can see a lot of Neil and Bill's predictions coming true. And it's funny, I think when you have an understanding of the fourth turning, you kind of understand what's happening in real time. And when you aren't familiar with that book and you sit and read it, you'll just find yourself going, "Holy cow, this is all happening right now." So it's one of those things that I'm a firm believer in cycles, both in society, in mankind, and in markets. And so I pay a lot of attention to this kind of stuff. Some people don't believe in it, which is absolutely fine. But it's tough to argue against this stuff when you read the parallels in history and previous fourth turnings, and you see what's happening now. It's really hard to say that there isn't a pattern here. And of course, we human beings are cyclical creatures. So, we all have the same life cycle. We all, have very similar cycles in our lives in terms of growing up, getting married, having kids, getting divorced in many cases, dying. So it's hard to argue against that. And if what Neil and Bill said is true, then sadly we are really just entering the dangerous phase of the fourth turning, where what we're seeing on the streets of America, for example, is going to get more fractured, more dangerous, and perhaps escalate to the point of conflict in the streets. Now, whether that's protesters against ordinary citizens, whether that's troops against protesters, it's hard to tell. But everything's heading that way, and obviously with an incredibly polarizing election coming up in November, we're just 60 odd days away from that now. I think maybe a little bit more. You have a potential catalyst. Should we see, for example, the same result we saw in 2016, i.e., Trump wins the college but loses the popular vote? That prospect frightens me enormously, because the outpouring of anger when it happened the first time was reasonably civil. I suspect, given what's happened in the intervening 4 years, we wouldn't see the same kind of civility again if that result would have happened. So, we really need a definitive, decisive result in this election. that's really the only chance we have to kind of tamp down any disaffection with the result. But look, when do you ever get a decisive US election? It's a rare occurrence. So I think November could be a catalyst for more strife.
Yeah, and you talked about the difference in left and right. And a lot of people see this dynamic as that's what's so divisive. But you were talking about how it's really not about left and right, because that's actually a good thing if we can come to a common ground. It's more so now that the battle is between the haves and the have-nots. And that's where it's super dangerous. Can you explain that a little further?
Yeah, look, it's very dangerous. I mean, my point to Eric was that we have conflict everywhere, right? This is an era of conflict, whether it's left and right, whether it's employed and unemployed now, whether it's old and young. We've got this boomer millennial kind of clash.
Yeah.
And more recently, it's the haves and the have-nots, the wealthy and the poor. And a great friend of mine, Steve Diggle, said to me a few years ago something which I kind of laughed off at the time. It's just a cute phrase, but it's actually very profound. He said to me maybe 5 years ago, he said, Grant, he said, it's never a good time to be poor, but this is a very bad time to be rich. And he was right then, and he's even more right today. And so what we've seen, particularly in the aftermath of the pandemic, the response to the pandemic has been from the same playbook in terms of stimulus. The money has gone into assets, it's gone to Wall Street. Yes, there's been checks mailed to people, but where have you seen the effects of that stimulus? You've seen it in the stock market, pure and simple. And most people in the United States don't have money in the stock markets. Yes, they may have some in their pensions, but what you're doing is making rich people richer. And there's a degree of tolerance to that if everybody else is okay. But when you've got 20 plus million people unemployed now, and you're getting headlines about how Elon Musk has made another $48 billion in the last couple of months, and Jeff Bezos has made $86 million in the last couple of months, billion dollars in the last couple of months. Those headlines, which are clickbait, which is how the world functions these days, tend not to draw admiration or tend not to gasp, a kind of silent shake of the head from people going, wow, can you believe that? They tend to focus on how poorly they're doing. If this guy's made $86 billion and I can't put food on the table, how about I get some of that, So that's what worries me, is that's the kind of environment, the kind of atmosphere that's being fostered. And, you can see it building in the Chaz in Seattle and Portland and Baltimore and Manhattan and all these places. You can see this stuff happening, and it's kind of quieting down a little bit now because it's not in the mainstream news. But if you go to those areas, the tension is still there.
Right.
And I say my big fear is that the election could be that catalyst that really makes people finally snap.
I think you can distill it down to, if asset prices and food prices are going up at the same time, that's when you get a lot of tension, right? I mean, you can.
Yeah, that's a great way of putting it.
Yeah. And so on that note, I don't know if you followed much about the TGA, the Treasury General Account, and that I believe there's over 1.7 trillion. There was last time I checked.
Yep.
And that's basically QE on steroids. From the standpoint of it, not only increases base money, but it increases broad money as well. So my concern, and I'd love to get your thoughts on this, is if the administration wants to buy the election, and I don't think that's something that'd be exclusive to Trump. I think any sitting president would do the exact same thing. And they've got this war chest, this bazooka, I think, as Luke Gromen calls it, that's just sitting there that they could spend it into the economy. If we think back to quantitative easing 3, that was what, 80 billion a month, and they can spend.
Yep.
I know I was talking to Lynn Alden the other day, and she says that they've earmarked about 800 to keep in there, but I think that's a moving target, that they'd be willing to spend that. But you think they're dropping $1 trillion into the economy in, call it, 2 months. I mean, what does that do to food prices, and what does that do to asset prices?
Well, look, I think what it does to those things is pretty clear to kind of figure out. I think we'll see both of them rise, but the troubling thing is that because of what's happened with QE for the last 12 years, it hasn't had that effect. It hasn't had that inflationary effect. And so there's going to be a lot of pressure on these. How do you say no to doing that because it will cause inflation? It's a very difficult argument to make because there's so much evidence to the contrary. Now, this is a different mechanism, but the pressure to spend that money is going to be coming from policymakers, not central bankers. It's going to be coming from people who want to promise and spend, to your point, to buy the election, right? They need to have the populace on side. So they're going to be pushing for that. And if the pushback is, this is inflationary, they're just going to say, listen, your balance sheet is now $7 trillion and we've got 1% CPI. So don't give me that about this being inflationary. Get out there and spend that money. And of course, this is a horse of a different color. This is a completely different way of administering that shot of morphine, or whatever you want to liken it to. This is going straight into the bloodstream, and that's a very dangerous thing to do. It's a very dangerous thing to do. So yes, I think you're right. The pressure is going to be on hugely to tap into those funds. I think we'll see it put to use. I'm pretty sure we will. They'll be arguing over it on both sides about how much of it to spend. The Republicans will want to spend as little of it as they can, but time it so that the cash hits people's accounts right before the election.
Right.
The Democrats will want to spend more of it and make it clear that they've talked the Republicans up into spending more of it, so it makes them look good. But they're going to be fighting over that pot of money, and one way or another, a big chunk of it is going to go into the economy. I'm pretty certain of that.
Yeah, and I don't think most people realize that this year the projected deficit is north of 4 trillion, and who knows where it will be. And if you look back at a chart, it took the United States, if I'm not mistaken, almost up to 2000, so 1776 call it, to 2000.
220 odd years.
Yeah, to get up to, let's call it 5 trillion. And we're getting there in 1 year. We're adding 5 trillion to the debt that took us 224 years. I mean, that is just an astronomical number. And I just don't see how that ends well. But I think I'm kind of preaching to the choir right there. I want to go back.
You are, but it also, let me just make this point. It also, it just shows you, it took all that time to get to that first trillion. But it just shows you what the inflation has been like since then. And if you look at that chart of the deficit, you'll see, or the national debt, sorry, you'll see how quickly after 1971 it accelerated. So yes, it took 200 years, but the big chunk of it was post 71, between 71 and 2000. And so the inflation, that kind of debasement of the dollar, is really what's happening here. So when they talk about being unable to create inflation over the long term, you can see it in that chart. You can see what inflation is. You can see how many more dollars are out there in the system, and they've had to be out there. And it's really that concept of inflation as prices going up. If you look at it as the decimation of the purchasing power of those dollars, and you need more of them to buy the same goods, then you can see that the inflation is in the supply of dollars, which is necessary in order for people to be able to afford this stuff.
Yeah, see, but then the pushback is that we've been in this maybe not deflationary, but disinflationary environment since, call it 1981, when Volcker jacked rates. And I know obviously Dr. Hunt makes a fantastic argument for that. If you look at the CPI, if you buy into the CPI, it's what it looks like. How do you look at M2 and velocity and the rate at which the government is saying that those prices are inflating? How do you kind of reconcile all of that?
Well, you look at the money supply and you look at what's happened to velocity, and those two kind of explain each other, realistically speaking. But when you look at what's happened, inflation-wise, look at asset prices. Look at house prices from 81 to now. Look at anything that is a material purchase, and then look at every adjustment that's been made to the CPI calculation since then.
Right.
Every adjustment was geared to lowering the CPI. No one's ever made an adjustment to the calculations that increase the CPI ever, because there's so much linked to it in terms of COLA payments that they just can't do that. And so every lever has been pulled to get the CPI as low as they can. Now they find themselves in a desperate struggle to get headline CPI. And it really is tough to understand why they want to do this, to get headline CPI 2 and above, and they've been banging the table about how they're very happy to let this thing run hot for a while if they can get it, which tells you they'll probably tolerate 4% inflation for a while. We've had that in the not too distant past, so it's not an outrageous sum. But with all that dry kindling in the system, 4% may be a very short pause on the way to 6% to 8% to 10%. It's hard to say now. And I spoke about this with Russell Napier in one of the other Endgame podcasts. Yeah. And he pointed out that yes, that's what he expected. The last couple of times we've got to 4% and it has stopped as this deflationary impulse has continued to kind of go through the economy. So those forces are there. But again, you and I could sit and talk about how they measure inflation all day long. If you look at the things you have to have, you look at food costs, you look at housing costs, you look at energy costs, you look at healthcare costs, you look at schooling costs, all those things. I mean, we have double-digit inflation in all of those. And, hedonics and substitution help, and the way the basket's calculated helps. But I think anybody, if you measure inflation as a government statistic, it is what we're told. If you measure it as a cost of living, i.e., what is your cost of living, the same basket of goods that you actually need to put on your family's table, and to keep them, having health insurance, and to keep a roof over their heads, and to keep gas in the car. We all know, we all live that day to day, and we all know that is not going up, or it's not unchanged or creeping up every year. It just isn't. So, the CPI is a barometer that they use to measure success and failure. What I think is more important, particularly right now, is to monitor inflation expectations, because as those start to climb, that's much more of a sign that people are going to go out and start that money moving through the economy quicker. If people expect inflation is going to come, then they're more likely to act as though it's coming. And this is a point I think I made it to Eric. I've certainly made it to someone recently that given the experience we've had in COVID, where everybody has a very recent experience of going to a grocery store and either finding basic everyday items not in stock, or shelves empty, or unable to buy bread or toilet roll or any of this, basic necessities. Right. When you have a memory that recent, it becomes much easier for people to pass costs on to consumers, because if the choice is paying an extra $1 for your loaf of bread, but you have a memory of not being able to get any a couple of months ago, you're much more willing to tolerate that $1 increase in the price of bread. So we could see pricing pressure being put onto consumers by manufacturers who are themselves under pressure from obviously the loss of manufacturing facilities in China, for example, and tariffs and all these other costs, which they've been unable to pass on to consumers thus far. But now there's potentially a window and a very good explanation they can make, in press releases and stuff. We're really sorry about this 5% increase in whatever, but due to COVID, due to lack of supplies and having to stock warehouse, whatever it may be, there are plenty of ways that you can get this message to consumers in a way that will exasperate them, but at the margin, will they, if they are able to pay it, will they be unwilling to pay it? And many of them won't be, I suspect.
Yeah, so you think that what's happened recently with COVID could be a trigger to an increase in velocity. Meanwhile, we have this powder keg of M2 money supply that's been created over the past 40 or 50 years. Is that what I'm hearing?
Well, it's possible, but don't forget the velocity, because people have been unable to go out and spend, right? They're not spending money at movie theaters and restaurants and stuff. We've seen that velocity drop. What's going to be very interesting is once things start opening up, and you see it now. Mike Green put a great chart up on Twitter this morning showing durable goods as a percentage of personal outlays, and it's shot through the roof, because of course people can't go out and spend on entertainment. So there's, they're buying new washing machines. I mean, people will always have this proclivity to spend money, but the velocity has fallen and is likely to stay low while people are, locked down, even in a small way. But we have, for example, we've got movie theaters opening this week in many parts of the United States. That's going to be very interesting to see what it's like, because stuff like that, movie theaters and restaurants are opening at a point where a much bigger percentage of the population are starting to say, this COVID thing, it's just all over. It's all overdone. It's not a bad thing. So we may see a lot more people venture out into cinemas and into restaurants as these things come back online. So we could see a big surge in spending. It could go either way, and it's tough to make that prediction. If you've listened to those podcasts, you've heard a very eloquent argument from Russell Napier for inflation, and an incredibly eloquent one from Lacey for deflation. Right now, Lacey's right. Lacey had a caveat as to how he could see inflation coming, which was, the Fed basically turned their reserves into money, and that really would be fuel on the fire. We haven't seen it yet, but interestingly, after Lacey and Bill and I recorded that conversation, a couple of Fed governors have essentially come out and talked about that as an idea, monetizing Fed assets, which would be a pure shot of adrenaline into the economy, and I suspect have catastrophic consequences. So, I mean, look, if Lacey Hunt is worried about something being highly inflationary, we should all be terrified about it.
Yeah, exactly. Isn't the same process happening with the Fed monetizing almost 100% of new treasury issuance? From the standpoint of it's basically like like Dr. Lacey Hunt says, that we're taking bank reserves and turning them into legal tender.
Yeah. I mean, look, we're getting there because foreigners have stopped buying treasuries to a large extent, and obviously with deficits of we're up to 3 trillion deficit now and change. A lot more of that is having to be monetized by the Fed, and so the process is happening, and I think it's happening in slow motion, but it's happening before our very eyes. The difficulty is, the last 12 years experience for people has been formative for many, and has created this sense of confidence that none of this stuff matters. Yeah. If we'd have said 12 years ago, if we'd have said 12 years ago, the Fed are going to do what they're doing now, people would have gone, well, this is ridiculous. This is going to be so inflationary. That's a crazy thing to do. But there's this built up of 12 years of kind of inflation, and nothing. Right. And so it's perfectly understandable that people would be unwilling to bet on inflation after such a long time, which is why, for me, my ears always prick up when people like Russell, who's been a hardcore disinflationist or deflationist for 20 plus years now. When people like him start saying, I'm switching, and Russell switched hard. He said he expects 4% inflation by the end of this year. And obviously that recent CPI print coming in double expectations has kind of, again, pricked a few ears up, but we don't have that blowout number, that 2+% print that will make people take notice. It's easy to look at a 0.6% month-on-month CPI raise when it was 0.3 expected, and instead of looking at it as being double that what the people were looking for, just seeing it as 0.6%. Well, that's not a number to be frightened of. But these things start building up, and very suddenly people start to get afraid. So, look, like everything right now, all this is stuff to watch, and it's all stuff that you have to be aware of the damage that could be done if these things start to matter. Do you have to act on them now? No, you don't. But disregarding them and saying inflation is not a problem, it's not something to be worried about, I think is a very dangerous mindset, because when inflation happens, it tends to happen very, very quickly, and you do tend to get, from 1% to 4% in a hurry, and suddenly people are playing catch up with what they need to do to kind of defend their portfolios, defend their lives against inflation, and it gathers momentum. So I think everybody needs to be on the lookout for inflation. They need to be listening to guys like Russell, who have a track record of being very, very right about this thing and being on the other side of the argument. And then you have Lacey again telling you why you don't need to worry about it. So both of them could be right. Frankly, it's all a question of timing, but understanding the arguments for them, and not necessarily saying, well, Lacey told me it's deflation, so I'm going to set my portfolio up for deflation, or Russell said the opposite, so I'm going to go for inflation. It's a very dangerous thing to do, to just listen to smart people. What the information they're giving you is a framework within which you can actually take what they've taught you and then do that next step. Apply that to what you see in front of you. Apply that knowledge to your daily thought process around what's happening. Don't just say, well, Lacey says deflation, so I'm okay for now. It's stress test. Take what Lacey said, and is he still right? Is he right tomorrow? Is he right next Monday? Or is Russell starting to come right? That's the important thing, and that's a big reason why Bill and I have been doing this. And I know it's a big reason why you do this stuff. is to help people understand that this business is not about stock tips. It's not about someone saying, hey, you know, buy XYZ or buy silver or buy gold. It's about understanding what to look for if you are going to buy silver. Because if you understand what to look for, you'll understand when you might need to sell it again. And so relying on people to hold your hand and just spoon feed you the answers is a really, really dangerous thing to do, and never more so than now.
Yeah, I think it's so important to understand the thought process and how these people that you're referring to are coming to their conclusions. You've got to understand it. A lot of times when I do a video, as an example, on deflation or hyperinflation or something like that, people in the comments will say, oh, well, why are you predicting this? Or you just did inflation last week. How are you predicting deflation now? And I said, no, you don't understand. My whiteboard videos are not predictions. They're explanations. That's it. And I may seem pretty convincing when I'm explaining something, but you need to take this ball and run with it. That's exactly right. And I wish more people would think that way. But I think just the way we're hardwired as human beings, we want to delegate the hard thinking and the heavy lifting to someone else, so we can pay more attention to the things that we want to, such as, you know, spending more time with our kids and worrying about walking the dog and soccer practice and all these other things. But unfortunately, you know, what's that saying, that if you want to be successful, you have to be willing to do the things that unsuccessful people aren't willing to do? And I think it applies to, I sent out a tweet this morning that applies to weight loss. I think it applies to making money, and it definitely applies to investing for sure.
Yeah, it comes down to discipline ultimately. I mean, everybody wants the shortcut. You know, humans are lazy by nature. Everything we've done in terms of technology has been to make our lives easier. I mean, that's what we do. And so, when particular markets are going up like they're going up now, no one's worried about them going down. So they just want, hey, which stock is going up? Tell me the stock to buy. Tell me the currency to be. You know, tell me what to do. Yeah. And that's fine. There's a lot of smart people out there, but you have to understand that they are every single one of them, no matter how smart they are, is making an educated guess about an unknown future. It's no more than that when you boil it down. Now, some of them research it more than others. Some of them throw darts at the board, and there's no telling which one of them is going to be right on any given day. But if you are going to rely on other people's guesswork to be the solution to your financial future, it's a very dangerous thing to do, unless you hand everything over to people that you trust, who are making a guess about the future and have a track record that you can sit comfortably with. If you want to take advice and then go day trade yourself, you know, every guy who's given you an idea, you better be listening to every word he says, because if he's the guy who's going to tell you when to take that thing off and you're not paying attention, you're going to end up holding those shares when he's told everyone else, hey, you know what, I saw some news today, I think it's time to get out. So, you know, by doing that, by taking someone else's idea, you make a rod for your own back, because you're not in that many times because you understand the reasons why you're in that, and you don't understand really the reasons how you're supposed to trade that. You've just got a great idea. And many times the worst thing that can happen is you have a great idea, you buy the stock from someone's tip, and the stock goes up straight away. Because what people tend to do is relax. And they stop really paying attention to it. And then obviously, if the stock goes down, the first thing they do, instead of selling it, is, okay, what happened? How do I find out why did the stock go down? What's in the news? And all the time you're reading this stuff, all the people that understand why it went down are ahead of you. Right. So, you know, it's so important to understand the hows and the whys, and not just the whats. And people, unfortunately, are, to your point, hardwired to really want the whats first and then the hows and the whys second. And it really should be the other way around.
Yeah, so man, there's a lot to unpack there. First and foremost, what I see just in the comments, and you know, I'm very fortunate that the YouTube channel gets over 1 million views a month. So there's plenty of comments to look at for sure. But if I had to break it down, I'll bet you people spend 99.9% of their time focusing on, is XYZ going up or down in price? And they spend almost 0% of the time focusing on how to structure a portfolio to where everything is matching up, and then how to control their emotions, knowing when to buy, when to sell, having a specific strategy. And you've been in this business for so long. How much of someone's success or failure is a result of them just being able to have a good batting average of oh, this is going up or this is going down, and then how much of it is a result of them being able to manage everything else that we talked about?
Yeah, look, I mean, having discipline and having a framework that you understand and is repeatable is so crucial to this stuff. Look, I could get in the batting box in a major league game, swing the bat, and I may hit a home run. It may happen once. I may just swing at the right time, make contact with the ball, and it sails over the outfield. Who knows, right? It's unlikely, let's face it, but it could happen. The chance of me striking out 9,099 times out of 10,000 is very, very high. But with investing, people, particularly in markets like we have now, which is unlike anything I've seen, catching that lightning in a bottle seems that much easier. And it's very difficult mentally for human beings who buy shares and they go up to think anything other than how smart I am. Very few people think, wow, that was lucky, right? People think I'm a genius, and they go and tell their neighbors, and they tell, hey, I bought such and such a stock and it's gone up, and I bought Bitcoin or I bought gold or whatever it is, right? And it's gone up. When stocks go down, people tend to look for someone to blame. I was either unlucky, or someone had information, or the guy who told me to buy this is an idiot. It just tends to be that way, and that's just human nature. It's very difficult to accept that you've made a mistake. We all struggle with it, and so having a framework through which you invest and having a certain discipline around that, and understanding not to let shares get too big, and understanding when to let winners run and when to take some of them off the table for pullbacks, and when to cut your losses first and foremost is crucial. And it's something that it really can't be taught, but you can learn it. And there's a distinct difference between the two. I can't teach anyone how to size their positions, but you can offer guidance. The only way you're going to really understand how to size your own positions is to learn, and that's by paying attention, by listening to people, by trying to understand it, by making mistakes, most importantly, but being honest with yourself when you make a mistake, and trying never to make the same mistake twice. That's what kills people, is making the same mistake over and over again. Einstein said that was the definition of stupidity, doing the same thing over and over again, expecting different results. But it's okay to make mistakes when you're investing. I mean, we all do it. Christ, I mean, if you're running a portfolio and you get 51% of your trades right over the years, and you can then add on top of that the ability to manage your losing trades so that you minimize the losses and maximize the profits you make on the 51% you get right, you will make a hell of a lot of money.
Right.
But it's about being disciplined. Don't get carried away when it looks so easy like it does now. Hey, Apple and Tesla and all these crazy stocks that are just doing things that make no sense at all to anyone that has a framework and has a discipline. And those people right now are probably missing out, and they're not making as much money as the people who just go, to hell with it, I'm just going to throw some money at the market and I'm going to buy all the stuff that's going up. The people who have a framework and a discipline are not making as much money now. But over the cycle, and these things are cycles, to get back to our earlier point, they will do better over the cycle, because it's very difficult to ride a train like this and be making money every day and to know when to get off. It's very difficult because it's such a seductive thing to wake up in the morning and get in the habit of going, how much have I made today? And watching, Dave Portnoy saying, how much am I making today? You get in that mindset. We saw it in 2000, and it's happening again now. But having a framework and discipline, understanding the risk reward of going long the equity market here, the risk is missing out on it, is in many people's eyes, right? The risk is not being in the market. And again, when you see that as being the risk, there are bells ringing all over the place. People will look at the S&P at a new record high, and they won't understand that only 11% of the shares in the S&P are making new highs.
Right.
that to a seasoned market professional is a huge red flag. It just tells you that unless you're in the 4 or 5 or 10 stocks that are really going nuts, you're losing money. And so as it gets concentrated in those 4 or 5 stocks that are making money, it becomes so much more perilous when people want to step away from those, or we get some bad news. And if you watch what's happening now with the economy, we're starting to see potential reconnections between the stock market and the economy as delinquency rates start soaring, as welfare checks start to run out, as stimulus runs out, as unemployment unexpectedly yesterday climbed above 1 million initial unemployment claims again. We're starting to see potential ways that the two can reconnect, the economy and the stock market. And anybody who pays attention will tell you, this is one of those things where we've got the alligator jaws, but we all know which one's wrong. Sometimes you think, well, is the bottom line going to catch up, or is the top line going to catch down? We all understand, I think, instinctively, that the stock market is wrong. What's happening to the economy is not representative of where the stock market should be. And so when this catch up happens, the stock market's going to fall. The economy isn't going to miraculously bounce back. So all this stuff is there. And it's incumbent upon people who are having money at work to understand all this stuff and not just be throwing darts at a board, because you've been hitting bullseyes for a long time now. But sooner or later, the dart's going to bounce out the board and stick in your thigh, and that's going to be hell of a painful.
Yeah, and I want to go back to the psychology and try to get some of that wisdom that you're talking about, because you've been doing this so long. And how dangerous is it, or how detrimental is it to someone's future investing career, let's say, if they have some bets work out for them, but they work out for the wrong reasons? Like, just to give you an extreme example, let's say someone's into numerology or something like that, and they're buying this stock because it ends in the number 7, and they're like, Grant, you got to buy this stock because it ends in the number 7. I'm telling you, it's going to go up. And sure enough, it goes up. So then they think it went up because it ended with the number 7. And if this happens, maybe let's say 4 or 5 times in a row, now all of a sudden they're convinced that this is the way to do it. And I don't think that's something too many people talk about. And to think that this one person, or even if they're like a Druckenmiller, I'm sure this has happened to him and even the best, that things have gone up for reasons other than the reason they thought. So how important it is to be cognizant of how little we actually know, and maybe how dumb we actually are. Does that make sense?
Oh, look, yeah, look, admitting that is probably the most important thing. Admitting and understanding what you know, and more importantly, what you don't know, is crucial. I mean, the numerology guy, there's no danger in that at all. What's dangerous is the next door neighbor who listens to him and says, hey, my neighbor's getting rich buying these stocks that end in 7. I can't miss out on that. I need to get in here. Right. That's the danger, because you take that as a strategy and you don't have any understanding in numerology. You just saw it working out for someone else, so you're going to follow it. And that's sadly what too many people do. But I think even if you talk to Stan and you read interviews given in the past, you'll see there that he will say, I had a position on the scenario I had invested expecting didn't play out, but the stock went up. Yeah. And the first thing they do then is go and understand, okay, why is it going up? Was my scenario wrong, and this is the scenario that's playing out, and this is also bullish, in which case that's fine? Or is my scenario still going to play out, which gives me confidence that it's going to go up again? This is kind of a bonus rally that we're seeing here for these reasons. Or is my thesis wrong, and this thing is bogus, and the stock is going up before it goes down? It's all about understanding that, and that requires honesty. It requires all of us to look in the mirror and say, okay, am I smart, am I right, or am I lucky, or am I a combination of the two? Right. Because being smart and right is a great combination. Being lucky and right is a very dangerous combination, because what you then do is assume the third thing. You assume you're smart. And we're all guilty of it. We're all guilty of it. The people that have longevity and success in this thing are the people who can look at that and say, I've been lucky. Yeah. And I've been right because I was lucky. I wasn't smart. And so I need to take action accordingly. And that may be reducing your position. It may be taking the profit and walking away and saying, wow, I got lucky there. And look, it may be doubling down, right? It may be the smart thing to do is understand why it went up. And hey, there's a whole new thing here I didn't understand. I was lucky, but I happened to get into something that is lucky. And now I understand the reason for it and I can see where it can go. I'm going to double down. But price is, as John Burbank said, a liar. And he was so true when he said that. People that get fixated on price and assume that price is the answer to everything and price is the arbiter of whether you're right and wrong, is a really dangerous thing to get into.
Yeah.
Saying that because this thing's gone from 100 to 110, I'm right. No, it's not that way at all. And people can get very complacent when things are going their way.
Why isn't that right?
And oftentimes,
I want to focus on that, because if it goes from 100 to 110, then they're going to say the market's right, I made money, I'm right. But I think what you're saying, and correct if I'm wrong, is that you're going against the probabilities and you're using ego. And if you continue to do that, although you're right this one time, eventually you're going to go bust.
Yeah, I mean that's the point, right? If it goes from 100 to 110, are you right? Well, it depends. Did it go to 100 from 100 to 110 because of a news release that you had absolutely no idea was coming?
Right.
Possibly, right? Possibly. Maybe they win a lawsuit or something, or an investigation goes away and the stock jumps 10%. You thought this new product they had was going to sell like hotcakes or get FDA approval. The result in the stock price may be the same. It jumps 10%, but getting cocky and thinking, hey, I was right, it's gone up 10%, and not understanding that it was the lawsuit that did it or the investigation being terminated, and just riding this thing is dangerous. It's about understanding that price isn't necessarily the correct way to confirm your view of being right.
Yeah.
But for a lot of people, being right is really all they care about. They just want to be right and have the thing go up. And that's great, as long as you understand, okay, it's gone up, not for the reasons I thought. So I need to watch because something may happen that means I have to get out, and I have to be aware of that negative news and be ready to get out, because I'm now long a theory that isn't mine. I'm long a price that's going up, and they're two completely different things. If you have an investment case for a stock, there are points you can check along the way. Has this announcement been made? Am I happy with that? Is this new chairman of the board accretive to my view? If you're just long a price, you're a hostage to fortune, because every day you say, well, has the price gone up or has the price gone down? Right. And you have no way of understanding what that is. And so it's a very dangerous thing to do. Making money and when you're wrong is wonderful, but have the hubris, or the lack of hubris rather, to take that position off and say, hey, I got lucky here. I made 10% on this, and out of nowhere, I'm going to take that off the table and I'm going to wait for my investment case to come back, and then I'll reinvest. I don't know, I think you can only really learn these things the hard way, learn them through experience, and hopefully learn them with as little pain as possible. But the market we have now is potentially so dangerous for people, because the lessons they're going to potentially learn when reality re-enters stage left are going to be so much more painful because of the elevated levels that the stock market's got to. And look, everybody listening to this who's in the markets and making money every day is going to listen to you and me and go, what a couple of losers, they don't get it. Oh, this guy, listen to this nonsense. That's fine. Nobody, you can't, it's really difficult to tell people this stuff when they're making money every day. I get it. I totally get it. But when things go wrong, they're going to want to maybe replay this conversation and many others that you've had on your great channel, and hopefully learn the lessons from it, because there's a lot of smart people offering insight and offering lessons that they've learned the hard way to try and save people doing that themselves. And, that will be immensely valuable when the pain stick is taken out and people start getting hit around the head with it.
Yeah. The question I always ask people, because I used to play blackjack quite a bit, is I say, if you're at the table and you got a 19, and let's say for whatever reason you're drinking or whatever, you get a 2, you get blackjack, but did you make the right decision or the wrong decision?
Perfect analogy.
I think
Perfect
that's
analogy.
what it boils
And would you, because you've done that, would you do it again next time? You know what? The chances of you doing it again just increased, right?
Yeah.
It's a dumb decision, but it worked. And so next time you're going to go, you know what? I'm feeling lucky. This could happen again. The
Yeah.
probability is exactly the same as they were last time, but you are more confident, and therefore it's an even more dangerous decision to make than it was last time.
Yeah. And how do we layer passive over this? Because when you were talking about how, it kind of reinforces and it's going up for reasons probably that are different than what you're thinking, especially if you're kind of the average person out there. And it takes me back to the conversation you had with Mike Green, where he was talking about the difference between passive and active in the sense that the passive manager, they have no decision making process other than, did I get another dollar? If so, I buy. If I have a dollar of outflow, then I sell, and that's it. And so if you see like all these financial advisors that just use maybe the past 20 years as just written in stone, as that's going to happen indefinitely into the future, but we see that maybe the market has gone up as a result of just inflows from passive, just buying indiscriminately, instead of people actually making decisions. Therefore, that now we've got this 20 years of data that's really a result of this passive flows. They think that all I have to do is go into passive and I'm going to get the same results over the next 20 years that we've gotten over the last 20 years. And that's very, very dangerous, especially if you understand what Mike was talking about. Do you want to unpack that a little bit for those people that might not have watched that episode?
Sure. You know, Mike is one of the biggest brains I've ever met in my life. He's an extraordinary intellect. I mean, he really is. He also happens to be a lovely guy. I kind of hate him. But, the conversation we've had with Mike, he's done a lot of work about this. And, when you put a brain that size and that powerful to work on stuff like this, the results can be extraordinary. And I think anyone that looks at Mike's work, if you go to, I think it's Logica Advisors or logicafunds.com, I'm not sure, but if you look up Logica and Mike Green, you'll find their website, and they put a lot of their work out there for free, and everybody should read it because it's truly groundbreaking stuff. Mike's talking about things that are new to all of us, and Bill Fleckenstein and I started this podcast, and we wanted Mike Green to come on as one of our first guests, and Bill's a seasoned veteran in this business, and he and I were left with our heads spinning by this, because the stuff Mike's talking about is really challenging for norms. And it explains a lot of why markets continue to go up, which is good because it gives you some comfort as when you kind of look at it thinking this makes no sense. Well, now it's starting to make some sense. But the frightening part is when Mike talks about what happens with the same machines in operation and the same strategies being employed when markets start to go down. And if you think about how crazy this is to the upside, and if you think about how consistent it's been to the upside, just imagine that put at work to the downside. And here's why it's way more problematic to the downside, because what tends to happen, in markets, as we all know, those two words, fear and greed, and markets are really just the manifestation of the fear and greed of everybody involved. And there really is nothing but that. We have periods of fear, periods of greed, and very, very short moments of apathy at bottoms where people just don't want to know about stocks. We had that in 1982 was the last time, really, I guess, when people didn't want to know about stocks. I guess you saw a little bit in March of 2009. People just exhausted and just didn't want to know. But the turnaround was so fast thanks to QE that you didn't really have that period, that lull that we had. So if you think markets are all about fear and greed, human beings, we are all fearful. Every single one of us is afraid of things, but we're not all greedy. Not everybody is greedy. Some people are very conservative. They don't get greedy. They're just cautious. They manage their portfolios, in a conservative fashion. And when we get manias like we saw in 2000 and we saw in 2007 and we're seeing now, they don't get sucked in. But when markets turn down, everybody gets afraid. Right. And so that's why markets tend to be way more volatile on the way down than they are, the old talk about, up the escalator and down in the elevator. This is why. It's because everybody suddenly starts to panic when markets go down and they get disorderly. And then you throw in the fact that, as we talked about on that podcast, if you want an offer in a stock, you will get one, no matter what hour of the day or night. If you want to buy a stock that badly, someone will make you an offer. The market's closed. Hey, make me an offer. Sure, I'll sell you 100 shares up 20% from the close.
Sure.
You want to buy them? That's the offer. And you will get that offer 24 hours a day, 7 days a week. If you want to bid when the market's falling, as we saw in March, I mean, the treasury market went no bid. Imagine that, right? And so when you have markets that go no bid, and this is always the way in falling markets, I mean, but in October '87, there were no bids. I mean, go to the, there's a great story about the guy trying to sell, I think it was IBM at one of the booths on the New York Stock Exchange. Says, what's the bid? And the guy says, well, I don't have a bid for you. One of the locals on the exchange. And I said, well, the machine says it's 87 bid. And the guy said, well, sell it to the machine then. I've got no bid. And that's how markets work on the way down, right? So if this passive turns around and you have these indiscriminate sellers as opposed to indiscriminate buyers because people are redeeming their funds because they're frightened, this is how you get flash crashes. The machine goes to the market to sell, the bid stack gets wiped out, and hey, we just traded down 30% on 100 shares. Why? Well, because BlackRock's algorithm didn't care, just wanted to sell them. So markets can get very disorderly very quickly, and that disorderly nature of markets just amps up the fear for everybody else. And so this thing feeds upon itself. So the rise of passive has really happened in tandem with rising markets juiced by all kinds of stimulus dollars, 23 trillion worldwide among the central banks. So that's been a perfect backdrop for the algorithms and the passive investing to kind of take that lion's share of the market. When things start to go south, it's going to be hugely problematic. And we had a taste of that in March. But at the time, it was nothing $3 trillion couldn't solve temporarily. And stock markets are back at all-time highs, even though it's on appallingly low breadth, which again, won't matter to people day trading, but matters immensely to seasoned professionals that know what to look for in terms of knowing when to step out at these market tops. And the passive phenomenon on the downside, we haven't seen it yet, but Mike made a very good case, and I won't take the words out of his mouth. I will let people listen to it as to why the market could literally go to zero if passive starts to sell indiscriminately. And his reasoning for that is something that you need to listen to him talk about as opposed to me. But it's concerning, and we haven't seen it yet. But professionals are aware that it's a problem. Non-professional investors aren't, and nor will there be. This thing will come out of the clear blue sky for them.
Yeah, well, I would be curious to see what your downloads look like on that episode over the next week or so, Grant, because I did a whiteboard video on it yesterday, and it's incredibly popular. It will probably have, it's only been out not even 24 hours, and I think it's got almost 45,000 views. So it'll get over 100,000.
That's great. I mean, look, that's fabulous. And look, people like Russell and Lacey and Mike and Jim Grant, and not just the people we've had on our podcast, but the guys you get on here, are doing a tremendous public service in just talking about this stuff. And look, there are a million people who can give you a stock tip, right? And some of them will know what they're doing, and some of them won't. And some of them will be that guy that thinks it ends in the sevens, he should buy it. But because there's so many of them, finding people like you who are willing to talk about the hows and the whys and not the whats, those are the people that your viewers should be seeking out. Look for people who will not give you a stock tip, because if you want a stock tip, you can find them easy. Go find the people who will explain to you what's going on, explain to you why you need to be cautious, how you need to think about this, what you need to look for, because that stuff is so much more valuable than any stock tip you could ever be given, I promise you.
Yeah. Okay. I know we're probably running short on time here. I want to quickly get your thoughts on Chris Cole's paper. I don't know if you read it, The Allegory of the Hawk and Serpent. And if you have, what do you think about the long volatility component? And are you putting that into practice in any way in your own portfolio? So how?
I think the one thing that we've seen, and this is very interesting, is that volatility is increasing everywhere except the stock market. Everywhere we look around us, on the streets of New York, on the streets of California, in Europe, in Turkey, in Greece, in Asia, the streets of Australia, everywhere you look, our lives are becoming more volatile. The division over COVID, the division over lockdown. So volatility is rising everywhere except the stock market, which is an interesting phenomenon. And again, what Mike talks about goes a long way to explaining why that is, explaining why volatility, the instrument, is actually much lower. And again, it's a very dangerous, deceptive thing to see, because volatility is ultimately what kills everybody. And Chris said to me a long time ago, when I first interviewed him, maybe 4 or 5 years ago, again, something that's stuck with me ever since. There is only one asset class, and that's volatility. And he's right. Getting volatility right really answers a lot of the questions you need to know. And so having structural volatility be this low in terms of the instrument, and realized volatility on the streets so high, is, again, it's one of those alligator jaws that has to resolve itself with the two meeting. And so if you think that the volatility on the streets and over Trump and over COVID and over poverty and over the rich getting, if you think all that stuff is going to naturally just quieten down and go away, then you can start to believe the instrument volatility and invest in markets. If you think that ultimately the price of volatility is going to start to match the underlying reality of the situation, then that's going to be incredibly dangerous for markets, incredibly dangerous. And we've seen, actually, interestingly, in recent days and weeks, days where both vol and equities are going up in a kind of almost calm fashion. And that's a really worrying thing. As volatility elevates, stocks shouldn't be just kind of quietly going up. So, Chris Cole is another guy who, is just such a phenomenal brain and a great communicator about these things. And people should go to Artemis Capital Management's website and read all Chris's papers. The Hawk and the Serpent. I mean, there are so many of his papers that make no bones about it. You have to want to understand them. They're not casual reads, but they are as accessible as the art of trading volatility can be. Chris does a job like nobody does in terms of putting them in terms that people can understand. And I would urge everybody to read everything that Chris has written, and some of it will be above your head. I'll tell you that now, but persevere and try and understand it. And if you can't understand a certain paper, don't let that discourage you from reading the others, because there's so much valuable information in them about how to think about the volatile world we live in, and the fact that it's being misrepresented by the instruments that are supposed to give us a gauge.
Yeah, and I think I'm sure I probably watched those interviews you did with Chris many years ago, and one thing that stuck with me is, and I'm probably not saying this right, but you'll probably remember when he said that volatility is never destroyed. It's only delayed or something like that. So if you've got this long period of volatility, it's only a matter of time before it's going to come back with vengeance and make up for all the time that the high volatility is going to make up for all that time when there was low volatility, because it never goes away. Am I saying that right? Or something like that?
Yeah, look, that's it. He said it basically, it can't be destroyed. Yeah, that's exactly right. And look, if you just think about it, everybody watching this should think about their daily lives, right? I mean, we live in a volatile world. Yeah. You can go to the grocery store 1,000 times, and then suddenly you happen to be in there when the grocery store gets held up by a guy with a gun. You can cross the same road 300,000 times, and then one day get run down on the same corner. We live in a volatile, unpredictable world. And what people trading stock markets try to do is they try to impose predictability on what is an unpredictable landscape. And so markets are going up, therefore they will keep going up. It's become predictable now. The markets go up every day. Well, the market's going up every day is the same as crossing that same street. One day a car is going to come around the corner and knock you on your head, and it's always when you get so comfortable that you don't bother looking left and right before you step onto that street, that you get hammered. And so, it comes back to what we spoke about at the beginning of this, understanding why, and not just relying on the price. And the fact that the price is higher means everything's okay. It doesn't. It just doesn't do that. It's telling you something, but underneath that are all kinds of other inputs that you have to understand. And volatility is crucial on them, particularly when we have that huge disconnect between what I want to call the realized volatility of life and the economy and society right now, and implied volatility, if you like, which is what the VIX is reading.
Yeah, one more question here, Grant, and I'll let you go.
Sure.
If my memory serves me right, you were in Japan in the late 80s and you saw that whole crash unfold, didn't you? So
well, I did, but Japan's interesting. Japan never crashed. Japan didn't crash. It stopped going up. It was going up every day. It stopped going up and it started going down.
Okay.
And that was December 31st, 1989.
Yeah.
I was there. I was in Tokyo. We were all standing on the desk where they shut the market at half day because it was New Year. Market hit a record high. Everyone was on the desk clapping and applauding. That was it. The next day it went down, and everyone said, "Oh, it's just gone down today." But Japan goes up every day. And then the next day it went down. And the next day it went down. And it started to continue to go down. And yeah, you had some sharper downside, but it never crashed. We never saw a crash in Japan, other than synchronized crashes in '87 or in '99 where the world was crashing. But Japan just stopped going up. It was the weirdest thing.
But from a psychological standpoint, isn't that similar to what's going on today? Don't you think, with passive, in the sense that people take a snapshot of what is happening today or what maybe has happened in the last year or two, and they just extrapolate that indefinitely into the future, and then they rationalize. Yeah. Oh, it's the United States. Oh, it's a developed economy. It's Europe. It's whatever, fill in the blank. So it's always going to be like this. And I'm assuming that in Japan in the late 80s, it was the exact same thing, because I'm sure there were bears back then. I'm sure everyone was.
Look, there were plenty of people. Yeah, there were plenty of people saying this is ludicrous and it's going to end. And of course, it did end. And just because you didn't have a crash, the market still lost 60% of its value. It just took a while. That's all. And of course, because of that extrapolation you talk about, people were very slow to catch on. I think as it stopped going up at the end of '89 and into '90, the bears started to press their shorts much quicker than the longs started to get out, because the bears have been waiting for it to roll over and start to go down. And once they saw that happen, and they saw, and Fleck and I have spoken about this because he was trading the same market, and he said, I saw things happen that hadn't happened before. When the market went down, I was used to it rallying. And so when you're watching for signs like that as a short and looking for the end of an overvalued market, you see them very quickly. You say, okay, I was waiting for that, so I'm going to add to my shorts. Whereas if you're on the other side and you're into that extrapolation mode, you tend to think, tomorrow the rally's coming. Tomorrow, well, we've now fallen for 4 days. It never falls for 5 days. Oh, it's fallen for 5 days. Well, the 6th day is bound to be the one. So you're just slower to realize what's happening. And that's very dangerous. And that extrapolation is kind of where we are now. Markets go up. Dave Portnoy, who, look, I don't care for his style, but I think, he's a marketing genius. But he said so many things that should be lessons to people for all the wrong reasons. When he sits there with his plastic hammer saying, stocks only go up, stocks only go up. There is a generation of people who are listening to that going, he's right. And there are guys like me that go, he's so wrong.
Yeah.
Not yet. And the not yet part is the crucial part, right? And if Dave Portnoy says stocks are only going up and sells all his equities and all his shares and wipes his hands and walks back to sports betting, he's got a case to be made for being the greatest investor of all time, right? He does. But the chance of him walking away at the very top and completely avoiding the thing, because you can see him getting so enamored with this, with being right every day and making money every day and becoming a guru. You can see him getting more and more inflated with it all every day that he puts a video out. And I would love to see him say, okay, I'm done with investing. I'm going back to sports gambling. I'm never going to invest in stocks again. I will bow down to that man and say, you know what, you are up there with the greatest investors of all time.
Yeah.
I doubt very much it's going to happen, unfortunately. And so we'll see. But it's that stuff. It's the stocks only go up. That is the classic rallying cry at the end of 1999. You know, tech stocks only go up. Internet stocks, buy them just for the eyeballs. It's all going to work out. And of course, it didn't. So we'll see. That's the beauty of it. We'll see. This, you know, Bill and I call our podcast the end game. We know that there isn't an end to this. There's an end to this chapter. Just like there was an end to the Japan chapter in '89, and an end to the tech chapter in '99, and an end to the housing boom in 2007-8. There'll be an end to this. It won't be the end, but it'll be an end, and how it unravels is going to be interesting to watch, I think.
Yeah, when I explain stuff like this on the videos, the most common comment I get is, like, as an example, when I was explaining Mike's thesis on the passive and active stuff going to zero and whatnot, is, well, the Fed will just come in and print the money to put in a bid. It always goes back to the Fed, you know, we'll just print the money. We're almost in this psychological mode where that's our default answers. The Fed will fix printing money. And at some point, you know, that runs its course. And I think you and Eric have talked about that most likely would be inflation. And ironically, it's what the Fed is trying to produce.
Well, and again, if you think of it, and this is what I think, why I think that now, after so many false alarms, I think this is why gold is starting to move. Because yes, I think we all understand now that the solution is the Fed has to print money. But if you look at how much money the Fed has to print, there's your inflation right there. Right, TARP was $787 billion. That's a drop in the bucket these days. QE1, QE2 was bigger. QE3 was 80 billion a month. Now we're throwing a few trillion at it. So yes, the Fed's going to print money, but what's the outcome of that going to be, depending on how much they have to print? And I think the market is starting to realize that, okay, we know what the solution is, more money, but we're now starting to see, hang on, they may have to print 5 trillion. And that at some point is going to have a problematic effect on inflation numbers. And I think people are starting to realize that there is only one solution. And it's like cowbell, right? The only solution is to do more of it. And so as more of this stuff happens and we get more cowbell and more printing and more then the inflation is going to come. And so, you know, owning real assets is arguably one of the only ways to protect yourself from that. And I think more and more people are cottoning onto that.
Yeah. Okay. Well, we'll leave it there on some advice for the average Joe and Jane. Make sure that you've got some hard assets. And I'd just like to remind everyone that saying, oh, well, Grant and George, they might be the boy that cried wolf regarding inflation. At the end of the story, the wolf shows up. So maybe that's
the bit people forget, right? The kid gets eaten at the end of the story. So, yeah.
All right, Grant, for my viewers who want to find out more about what you do, they have to go to the end game. That is for sure.
Yeah, you'll find the end game in the iTunes store if you look for the Grant Williams podcast. There's kind of 3 different series I do under that banner. One of them is the end game with Bill Fleckenstein. There's another one called the Super Terrific Happy Hour with my dear friend Stephanie Pomboy, which is, again, in fact, she's fantastic. We have some great guests on there. And then I do one with Ben Hunt called the Narrative Game, where we talk periodically about some of the narrative-based things that are going on. They're all fascinating in their own way, and they're all very different in their own way. So just find that at the Grant Williams podcast, and head to my website, TTMYGH, to find out more about things that make you go home. That'd be great.
All right, Grant, I appreciate your time. I can't wait to do it again.
George, always a pleasure, mate. Thanks for having me.